Hey everyone, Couch Investor back to another Lemonade video for today. So a quick update because not much has happened with the company. The stock, as mentioned in the last video, did we bottom or did we go to $45? We went to $45, but the business, nothing really has changed. I'm going to touch on some more important stuff, which Daniel Schreiber, the CEO and co-founder of Lemonade, has talked about on a Motley Fool podcast. So I'm going to go over the major highlights there. Some very, very interesting things there that we didn't know, maybe you might have known, but didn't really think of. So if you're interested in that, sit back and relax, maybe hit that subscribe button. We're on the way to 20,000 subscribers. Also, I want to thank everyone that has been subscribing lately. I really, really appreciate that. So without further ado, let's dive into this. Alright, so first up, he got asked about Lemonade's renters insurance and why they started with that product and how they see it evolve. So obviously renters is the cheapest one of the bunch, but also the easiest one to upsell after that. When you start with renters, eventually you become a homeowner, maybe you have a pet, so you have pet insurance, then maybe car insurance, life insurance, etc. Also, by the way, if you're using Lemonade's renter insurance, you're probably saving up to 50%. 50%, 50. So it's pretty good. Then he got asked about investment income. Most of you know insurance company have an investment portfolio, and that's one of the main reasons and the main ways they earn a lot of money. For Lemonade, this is something they're thinking of, not right now, but in the future. But this is not going to be the main source of income. This is just going to be an extra part of it because they do see themselves as a tech company. That's why they call it Insurtech. So investment portfolio, investment income is coming for Lemonade, but in the future. And then we go into the more interesting stuff, which is the main difference between them and other Insurtech companies, to which he answered that he's actually very, very surprised to see that there are not more companies popping up, more Insurtech companies popping up. You can name just, I think, a handful of Insurtech companies, and most of them, and this is the most important part, is that they're all focusing on one insurance product. Root, Metromile, which obviously Metromile will now belong to Lemonade coming next year, are all focusing on car insurance. Hippo focusing on home insurance. With Lemonade, they don't want to focus on one specific product. They want to focus on insurance as a whole. When you come to Lemonade, they'll be able to offer you everything you need for insurance, whether it's renters, homeowners, life, pet, car, maybe in the future, travel as well. Because it's much easier to succeed when you can offer all of that. He said it a couple of times already, Lemonade were operating with one hand behind their back because they didn't have car insurance. Because when somebody comes for home insurance, most of the times they also own a car, so they want to bundle that. When you can bundle things, it's much cheaper. So sometimes they wanted to offer home insurance, but then another company comes around and said, look, we can offer you home insurance and car insurance. We can bundle that, which will become much cheaper. And this is one of the ways they were losing customers. Now with car insurance coming up and the acquisition of Metromile, bundling will become much easier. And talking about other insurance companies, the older ones, he was asked why they're not moving into a more tech type of environment. And the answer here is pretty clear because the investor base for those companies are very old school. They like those fixed 5% yield each and every day. I say 5% because it's a number around that. And if those insurance companies would move into a more tech-like environment, those investors would probably not get those fixed yields each and every year. And that's something they would not like to see. And that's why all those old insurance companies aren't really moving that much into the tech environment. By tech environment, I mean getting insurance more personalized for you, for me, for your dog, for whatever, more data points, cheaper price for a particular person, maybe more expensive for another. They're not willing to take that risk. And now before we jump into the question with regards to valuation, how the market should value a company like Lemonade, because obviously it went public a year and a half ago, went all the way up to 180, now all the way back down to 45. By the way, they went public at a price of around $28, $29. But how do you evaluate Lemonade? We're going to talk in just a bit. But first, I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 free stock picks from their popular product, Stock Advisor. Now, Stock Advisor has beat the market by more than 4x. So all you have to do is go to fool.com/couchinvestor to get your free 10 stock picks now. So valuation. The multiple right now, the trailing 12 months multiple for Lemonade is 25 times. Now, it's very, very expensive, right? It was even more expensive at the start of this year. What did change for the business? The business just became much better. The stock price just went down. But with Lemonade, with insurance companies, it is not really revenue that you should watch right now. It's more in-force premiums. And if we use in-force premium as a metric here, the multiple goes down all the way to 8 times. 8 times is not 25 times, but 8 times is also not that cheap. If you compare it to other insurance companies, the old ones, they have a multiple of 1, 2, maybe 3 times. So you see there's still a big difference. But Lemonade, since it's a young company, since it's still growing 80 to 100% year over year, maybe you could say, all right, 8 times is not that bad. And also another reason why it's very, very difficult to value this company is because GAAP accounting practices does not allow you to recognize reinsured premiums, which obviously is now 70 to 75% of Lemonade's business gets reinsured. So there is that. Now let's move into the last couple of parts, which is one, Metromile, then life insurance, and then where does he see Lemonade in 10 years, 20 years from now. So the Metromile acquisition was, in my opinion, a very good one because it gets them 49 state licenses to launch car insurance. Right now, Lemonade just has one. Soon we'll have another. They also get $250 million in cash and $100 million in in-force premiums, which is great because this deal is an all-stock deal. Since then, the stock price for Lemonade has actually gone down. And as I said in my last video, the car insurance industry is worth around $300 billion. Lemonade, when they announced their car insurance, they said that a large majority of Lemonade's existing customers are car owners. And they already spent, wait for it, about $1 billion on car insurance each year. Imagine the impact this will have on Lemonade's business going forward. I don't think people realize the opportunity here with car insurance, especially car insurance provided by an Insurtech company, or even we can see it as Tesla. Then he got asked about life insurance, which right now it's pretty small, it's 2% of their books. But if you just look in dollar terms, it is generating 3 times as much as renters was back when that started. So that's great. It also have over 90% gross margins because Lemonade is not underwriting it. It is just reselling it. And then the last question is probably the one you want to hear. Where will Lemonade be 10 years from now? Where will Lemonade be in 2031? So he said they want to see Lemonade's business 10x from today. And then after that, 10x again. So basically 100x. Whether that's going to happen in 10 years, in 20 years, they don't really care about the time frame. They just want to see their business go from $400 million in in-force premium to $4 billion to $40 billion. And guess what? Even if they get to 40 billion, they will still be half the size of State Farm, which is insane. And this is just showing you how big the opportunity here is with Lemonade. If you cannot handle the volatility, but you still want to look for those 100x, then I'm sorry to say this is just not going to work out for you. 2020 has produced many short-term investors. You cannot go and say, I want the next 10x without having the probability of your stock going down 50% or so. I'm a Tesla shareholder. Tesla over the last couple of years have had those crashes, has had those 50% drawdown. Guess what? It's up 10, 15, 20, 30% or so in the last couple of years. So if you want those high returns, you do need to be prepared for those huge drawdowns. And that will be it for this video. Let me know down in the comments below if you've been adding some shares in your portfolio this week. Doesn't have to be Lemonade per se, maybe other stocks. Let me know down in the comments below. And if you like this video, leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button. As always guys, take care, stay safe, and see you all in the next video.